Celsius is one of the hottest energy drink companies right now. In the last quarter alone, their revenue almost doubled thanks to the acquisition of Alani Nu, and now they have announced a major new deal with PepsiCo, taking over Rockstar Energy in the United States and Canada. But with the stock trading at around $51, the big question is Celsius still a buy, or has the stock already run too far ahead? For those new here, Celsius isn't just about energy drinks anymore. They now own three powerful brands: the Celsius brand itself, Alani Nu, and now Rockstar, and their Pepsi as their distribution partner. These drinks are showing up in the more stores, more coolers, and more international markets than ever before. Hey everyone, my name is Ricky, also known as Peaceful Investor. And on this channel, I break down stocks, financial reports, and long-term investing ideas in a simple and easy way so you can make better investing decisions. I put a lot of effort into researching, analyzing reports, and simplifying the details for you. So if you find value in my videos, please make sure to hit that subscribe button. It really motivates me, helps me grow this channel, and allows me to keep making more videos like this for you. And as always, this video is for educational purpose only. It is not financial advice. Always do your own research or consult a licensed financial advisor before investing. Investing involves risk and you could lose money. And I may hold position in the stock I talk about, so keep that in mind when you watch my analysis. We can see how Celsius has grown over the years from Q1 2020 through Q2 2024. Revenue kept climbing quarter after quarter in a very steady pattern, showing consistent demand and strong execution. This steady rise really highlights how Celsius built its foundation before stepping into the big acquisition. But starting with Q3 2024, the momentum began to cool as growth slowed compared to earlier quarters. In Q4 2024, the company actually posted a year-on-year decline, marking the first real setback after years of steady expansion. That weakness carried into Q1 2025 as well, when revenue dropped again by 7% year over year to 329 million, reflecting timing issues with distributor incentives and heavier promotions. Then came Q2 2025, when the story completely turned around. Revenue jumped to 739 million, up 84% year on year. The growth was powered by 438 million from the Celsius brand itself and 301 million from Alani Nu in its first consolidated quarter. In terms of profitability, gross profit was 380 million with a margin of 51.5%, slightly down versus last year because Alani Nu has lower margin profile and due to a one-time 21.7 million purchase accounting adjustment. But excluding that, the gross margin would have been closer to 54%. Operating income was 143 million, representing a 19.3% margin, while adjusted EBITDA more than doubled to 210 million at a 28.4% margin. Net income was 99.9%, basically 100 million or $0.33 per diluted shares, while adjusted EPS was 0.47, up 68% year on year. Sales and marketing was 152 million or 20.5% of revenue, showing leverage improvement, although management said these costs will step up in the second half of this year. NFL ads, new campaigns, and retail activations. These are the main reasons the cost will go up. Overall, this quarter showed Celsius delivering hyper growth, absorbing the Alani Nu acquisition and still expanding profitability on a adjusted basis, even though gap margins looked pressured by deal cost and one-time items. Looking beyond earnings, the cash flow statement gives us more insight. Celsius generated 147 million in cash from operations in the first half of 2025, which was solid but down from last year because accounts receivables ballooned by 143 million as sales grew faster than collections. In simple words, they sold a lot more product, but much of that cash hasn't been collected yet. Free cash flow excluding acquisitions was still positive at about 132 million after 15 million of capital expenditure. But because of the 1.26 billion cash outlay for the Alani Nu acquisition, total investing cash flow was sharply negative, which is why company ended the quarter with 1615 million of cash, down from 819 million at the end of 2024. On the balance sheet, asset jumped to 3.28 billion as goodwill and intangibles from Alani Nu was added, while liabilities rose with a new 900 million term loan. Equity also strengthened because 1.71 billion supported by both retained earnings and new preferred shares. So while Celsius has taken on real debt for the first time, it still has a healthy cash position, a strong equity base, and the ability to keep funding growth. Looking ahead, Celsius has several growth drivers lined up. The overall ready-to-drink energy category in US is still expanding at around 15% year on year, but Celsius and Alani Nu are growing almost twice that pace, which means they are steadily gaining market share from Monster and Red Bull. For the Celsius brand itself, retail sales grew only 3% in Q2, while distribution points increased 17%, which shows they are on a lot more shelves, but consumer sell through hasn't fully caught up yet, leaving room for stronger growth ahead. Alani Nu continues to be a major growth engine with retail sales up 129% year on year, supported by seasonal launches like Witch Brew, Pumpkin Spice, and new winter flavors. On the top of that, the Rockstar acquisition gives Celsius an additional brand with nationwide recognition, and with Pepsi as a distribution partner for all three brands, shelf space and market penetration should keep improving. Management also expects about 50 million in annual cost synergies within 2 years, which will support profitability even as they invest more heavily in marketing. Finally, international markets like the UK, Australia, France, and New Zealand are ramping up with Pepsi and Centauri giving Celsius a global runway for long term growth. So, to quickly recap what we have covered, Celsius had years of steady revenue growth from 2020 through mid 2024. Then momentum slowed with declines before bouncing back in Q2 2025, with revenue up 84% year on year. Profitability looked strong on adjusted basis, with EBITDA more than doubling, although gap margins were pressured by deal cost and a one-time accounting adjustment. Cash flow from operations stayed positive even though receivables tied up a lot of cash. And the balance sheet shifted with the 1.26 billion Alani Nu acquisition and 900 million in new debt. On the strategy side, Celsius is expanding distribution, Alani Nu is growing rapidly, Rockstar adds scale, and international markets are opening up with Pepsi and Suntory. The key positives are clear: hypergrowth, stronger portfolio, deeper Pepsi partnership, international runway, and the cost synergies ahead. On the other hand, the risks include short-term margin pressure, higher debt, integration challenges with Rockstar, and the fact that the stock is still priced at premium. On valuations, Celsius currently trades at about 7 times of sales, 50 times of earnings, and 38 times of operating cash flow, and 40.6 times free cash flow on a trailing 12 months basis. If we look forward, analysts expect stronger earnings and sales, which brings the forward PE down to around 43 times and forward price to sell about 4.5 times. That means the stock looks expensive on past numbers but more reasonable if you believe in the future growth. For investors, that takeaway is this. Celsius has transformed into a multi-brand energy powerhouse with Pepsi as a strong partner and international expansion just beginning. The opportunity is huge, but the price you are paying assumes they keep delivering on growth and integration. If they do, the upside is there. But if growth slows again or margin stays pressured, the stock could face a reset. As always, this isn't a financial advice, it's just my analysis. This is a business I really like. It's simple to understand and it's a product I even enjoy drinking myself from time to time. I first invested when the price dropped to about $25 and I sold when it hit around $40. Looking back, I wish I had held on because the stock went much higher and reached at almost $62. Now the price has come down to around $51. After analyzing this quarterly report, I have decided to start a position again in the business. I'm going slow, just starting with a small position, and if the price drops more, I plan to keep adding to my stock. If you enjoyed today's video, please subscribe to my channel and I will see you in the next one. Thank you.